A recession can be a difficult time for businesses and individuals alike. With job losses and financial insecurity, it can be difficult to think about building wealth. Production slows, unemployment increases, and consumer goods, commodities, precious metals, and real estate prices decline. Hello ladies and gentlemen, it's Makita here bringing you another video today. In today's video, we'll review some of the ways middle-class Americans can build wealth during a recession. If you enjoy these videos, make sure you leave a thumbs up and subscribe. And without further ado, let's get right into it. The R word has been trending in every headline recently, but what exactly is a recession? The basic rule of thumb to identify a recession is when there is a decline in 2 consecutive quarters in a country's gross domestic product, or GDP. Or more recently, the National Bureau of Economic Research, NBER, which dates US business cycles, defines a recession as an economic contraction starting at the peak of an expansion and ending at the low point of the ensuing downturn. No matter which way you spin it, one thing is true: we are in a recession and have been for some time now if we look at the data. The amount of growth that we saw in the capital and real estate markets wasn't healthy, bringing us to the inevitable, a much needed economic reset. The economic system is a complex machine with many parts, and when something goes wrong in one area, it can cause an imbalance that is not ideal for any party involved. With that being said, recessions often are just as chaotic, if not more, than booms, because people tend to panic during these time periods when business gets slower or less lucrative. So there needs to be plenty of patience from all parties until equilibrium has been restored once again. As you remember from our last video on the CPI report, we covered the numbers on the previous month's data when inflation was at a 40-year high of 9.1%. We have the latest release of the CPI data as of today, and it came in under all major economists' predictions for the month of July, coming in at 8.5%. In this situation, there were two camps. Some forecasted that it would fall around to 8.7%, and others forecasted that it would exceed 10%. And in light of this news, market indexes closed in the green today, and Bitcoin jumped by 4% as investors worries ease. This is excellent news, but we aren't exactly out of the woods yet. The consumer price index has undergone numerous revisions over time, and the way the CPI data is calculated may not give us the full scope of the amount prices rose. There are a few issues with the methods used to calculate the CPI. First off, there is no account for the substitution bias. The substitution bias is when the price of something changes, consumers will often adjust their purchasing behavior to maintain equity. To give an example of this, let's say the CPI basket is iPhones. In 2016, the iPhone 8 was released and cost $699. In 2017, the iPhone 10 was released and cost $999. That's a 43% price increase. Now, due to the increased price, consumers have decided to switch to the Google Pixel, priced at $649, lowering their spending to keep costs of living lower. It's safe to say that it's easy to overstate or understate the CPI data. Another issue is the quantity and quality of products that you get. You may be paying the same price, but either for a cheaper quality product or less of it, also known as shrinkflation. Here's an example of this as well. With Fritos, now you get 5 chips less per bag. Pressed toothpaste is about 0.3 ounces less, which amounts to 15 euro uses per tube. There are around 70 fewer raisins per package for Sun-Maid raisins, and around 20 sheets less per Charmin package. During a recession, there are many ways you can come out ahead once it's over. If you have been laid off or are facing reduced hours, use this time to improve your skill set. Learning new skills or getting certifications can make you more marketable and help you earn a higher salary when the economy improves. This, of course, is easier said than done, which is why another thing to keep in mind is minimizing your expenses down to the necessities only. Cutting back on non-essentials and paying down debt can free up cash flow and help you weather the storm. Unemployment is on the rise, hiring is slowing down, and companies like Coinbase, Robinhood, and Netflix have already been laying off employees. Snapchat also prepares for job cuts after missing earnings. They did refuse to comment on that and claimed that they would slow hiring. Of course, this is not a positive thing, as a healthy economy requires there to be high production, and for there to be a substantial amount of production, there needs to be employees who are producing. But another way to look at this is, if you are self-employed and you're looking to grow your team of staff, you won't have any trouble finding employees and negotiating fair salaries. We previously made a very informative video on this topic, and if you haven't seen it yet, check it out for a detailed breakdown of the job market. I linked the video in the description below. Another way to build wealth during a recession is to invest in assets that hold their value. Buying property or investing in golds or other precious metals can even help you navigate these challenging times and come ahead when the economy recovers. This brings me to my next point. During a recession, things that are usually on a steady upward trend are being sold at a discount and allow retail investors to jump in and buy appreciating assets that they would otherwise not be able to afford. Here's the historical chart for the S&P 500. As you can see for yourself, corrections are bound to happen, but it's still a continuous upward trend. For example, let's say you are looking at a stock that is trading for $100 per share and has historically gone up 10% year over year. If the market has corrected and the same stock is now trading at $80 per share, you are effectively getting a 20% discount. Of course, there are associated risks with any investment, but if you are patient and ride out the storm, there's a good chance you will come out ahead. Also, it's important to be extra cautious when making trades in today's market, because the meme stock frenzy is on the rise again. Trying to time the market is never wise, and it can have severe repercussions when trying to make a quick buck by following the crowd. Buying a stock because it's trending on forums or headlines might not be the best idea. Frankly, if you're reading about it in a news article, it's much too late to jump in. It's easy to get the FOMO syndrome, also known as fear of missing out, when you see teenagers becoming millionaires overnight from taking huge risks on very volatile stocks. However, what they don't talk about is the other half of it, and that is the people who bought at the top in hopes of the stock continuing to rise and took huge losses when they panic sold after a significant decline. Buying shares of a company that you truly believe in and understand will benefit you down the road. Your best bet is to buy and hold into dollar cost average, which is essentially investing investing a fixed amount per month, no matter the cost of the stock or asset you're investing in. Be like Buffett and have diamond hands. This strategy has proven itself many times over. Again, this is by no means financial advice, and you should always make trades that you feel would be right for you and your goals, regardless of what online finance YouTubers may tell you. Recessions can be difficult, but there are ways to come out ahead if you play your cards right. Real estate properties can also be purchased for significantly less during a recession when the number of homes for sale grows quicker than the number of buyers looking to buy a home. Basically the exact opposite of what we saw in the last 2 years when the ratio of home buyers to homes for sale was so unbalanced that properties were getting 30 to 40 offers. A recession gives home buyers the advantage of being able to negotiate terms and purchase prices. Although rates are on the higher end, saving up some money for a down payment can help you buy that rate down. But as with any market condition, there are risks associated with buying a property during a recession. One of the most apparent risks is that you may lose your job or have your hours cut back and be unable to make your mortgage payments. Another risk is that the value of your property may go down instead of up once the recession is over. But no one can predict the future, so it's essential that you do your own research and only purchase the property if you feel comfortable. The real estate market, similarly to the capital markets, has its booms and busts, but still continues to grow steadily over the long run. You can't go wrong with purchasing a property and holding it for an extended period of time, allowing it to appreciate and build equity, which then could be used to cover the down payment for a second home as an investment. Well, if building a real estate portfolio is something that you want to pursue. At the end of the day, homeownership has been the primary tool for building wealth among middle-class Americans. Recessions don't last forever, and the sooner you start preparing for the next one, the better off you'll be. That's going to wrap it up for this video. If you made it to the end, thank you for watching. Also, if you enjoyed this video, please don't forget to leave a like and subscribe, and stay tuned for more.